What's going on, guys? Welcome back to the channel. I hope you enjoyed your holiday, but we have some interesting things to get into here in this video. Charles Schwab is increasing margin requirements for AMC as well as GameStop, DWAC, and car stocks. So this is a sign of what is to come, as we seen in January and in June, before we actually seen those big run-ups, or when it first started. You've seen these margin requirements go through the roof, and that's exactly what is happening again. And on top of that, we are going to talk about the institutional investors that have been buying AMC at a 10x faster rate in the month of December as they did from October to November or August to September. They're buying the stock 10 times faster in the month of December. Overall, really crazy. And then on top of that, we're going to talk about the Spiderman numbers that are now coming out, because they are huge. And I think it just goes to show the fundamental case for AMC is very strong heading into 2022. And you do not want to be on the back end of these short positions heading into 2022. So I think January is going to be very exciting overall, and we'll talk about that as well here in this video. But let's not waste any more time with the intro. Hit the like button for me. Consider subscribing to the channel. Let me know down below in the comment section what do you guys think about this information. And with that being said, let's get straight into it. So Charles Schwab says, we've adjusted margin requirements on certain securities. Car stock, 300% margin requirement for short positions and 100% margin requirement for long positions. Same thing with DWAC. AMC is at 100% margin requirements for long positions, 200% margin requirements for short positions. For options, long calls, long puts, and covered calls are permitted. Selling short put options is permitted if you have available funds to cover the entire amount of the exercise. Selling naked calls is permitted if you have available funds for increased requirements. GameStop, 100% margin requirement for long positions, 300% margin requirement for short positions. But why this is actually very substantial, 200% margin requirements even on AMC for short positions. Essentially, if you had $100 worth of AMC stock on margin, you'd have to have a margin requirement of $200 for that. That's an insane amount right there. Usual margin requirements are like 40%, 45% on any given stock. Different stocks with different volatility levels have higher margin requirements, but generally speaking, about 40%, even on your riskier stocks like Lucid Motors or, SoFi, DraftKings. Some of the other stocks that I own are only 40% margin requirements. But why that's more substantial than something like DWAC with a 300% margin requirement is because DWAC has way less shares. It's a lot easier to move that stock comparatively to AMC. But AMC is much more explosive. So there's going to be a lot more money piling into AMC for potentially a longer period of time. And it wouldn't surprise me here, once you start to see AMC break out past those key threshold levels, to see more requirements get put into place at different brokerages. And that will be more confirmation of some explosive moves that would be coming after that. So I do expect more brokerages to follow suit on this, because these brokerages, they're going to act first rather than later. When they suspect or think we could see a explosive price action move in AMC or any other stock, they're going to raise these requirements before that actually happens, because they don't want to be on the back end and have this huge problem of these over leveraged short positions getting whacked and they didn't have enough margin requirements on those hedge funds. So all in all, a good thing. If you don't know how the margin requirements work, essentially 100% margin requirement turning into a 200% margin requirement puts a lot of pressure on the hedge funds, because we know through all the rule changes that we have gotten since June, really since January, you can't use bullshit collateral anymore. You have to have cash or high quality collateral. So essentially, if you had a 100% margin requirement previously, which is likely where it still was at, if you had $100 in short positions, you had to have $100 of high quality collateral to back that. Now it's at 200%. That means you have to have $200 of high quality collateral to back the same $100 of margin you have in the stock. So this also incentivizes hedge funds to want to cover on their short positions faster, because it locks up more capital. And ultimately, if you have a lot of capital locked up, in these short positions, you're restricted on what you can do, right? If money is sitting somewhere and you're not making money, then you're losing essentially the time value of what that money could have done for you. All right, now let's talk about the Spider-Man numbers and why hedge funds, I think, are buying the stock at a 10x faster rate in the month of December, and why this is such a bullish thing for us as the holders of AMC. So Spidey is set to hit $1 billion global today, a COVID era first, domestic at $405 million ahead of expected Christmas swell. That is crazy right there. For AMC to be free cash flow positive, AMC needs $5.2 billion at the domestic box office. Domestic meaning US and Canada. If Spider-Man did $405 million, that's going to put them very close to being free cash flow positive by this next upcoming quarter, by Q4. But I don't really expect them to be free cash flow positive in this next quarter. I think Q1 of 2022, given all the insane movies we have coming out, expected blockbusters left and right, that's when they will get free cash flow positive, and they will be able to sustain their business without bleeding any more money. That opens them up to do whatever they want to do, issue a special dividend, keep growing the business, pay down some of their debt. It gives them a lot of options. And it's obviously a sign that movies are not going away. You can't replicate the theater experience with the best at-home theater. You just can't do it. There's nothing to replicate it. But if we do take a look at the highest grossing films at the box office throughout the history of the box office, we could see that with Spider-Man over $1 billion, let's say Spider-Man does $1.5 billion at the box office, which by the time it's not in theaters anymore, I think it's going to do at least $1.5 billion. That's going to put this movie in the top 10 biggest box office movies of all time. That's going to be right ahead of Frozen 2, right behind Furious 7. So I think it's safe to say there's no short case left on AMC stock, especially heading into 2022. If these movies were flopping and not getting that attendance level, then this would be a totally different story. But AMC is set to make a possible record amount of cash, in my opinion, in 2022, since the business was forced to basically slim down and to lose a lot of the fat that a business that's operating for 100 years typically does. There's a lot of baggage involved with legacy businesses that have been around a long time. When 99% of your revenue is gone overnight, you have to think fast and figure out how to lean down your business and cut costs into every corner possible just to survive. So I think that's ultimately what is going to make AMC an even bigger company starting in 2022. So very exciting. And I think that's partly why hedge funds are buying this stock right now. I think you're likely to see a hedge fund versus hedge fund situation, because when it comes down to it, these hedge funds, they might collaborate on things, but ultimately they are adversaries. They are competition, and they want ultimately to be right. We know they want to be right, but what do they want more than that? They want clients' money. So I think it looks a lot better to say, hey, we made X amount of dollars going long an AMC stock rather than losing all this money shorting the stock. It's quite simple. You don't keep customers if you're losing money on the same bad short positions, just like these shorts are going to do. So I think on that aspect as well, shorts will be more incentivized to cover, because it looks bad saying, hey, I lost $5 billion in a week shorting AMC. Keep your money invested in me. This is the third time in 12 months as this happened. I think it goes without saying. But like I said, at the same time, I think hedge funds, they are loading up on AMC, just like we can see from the data. Now they hold 172 million shares of AMC. Just last month in November, they held 140 million. That's a almost 33 million greater share position that these institutions own in the month of December. And I think that tells a lot. It also helps to support the valuation of AMC at the current moment, because if these hedge funds were buying this on this way down, right, in between the really $35 and $20 range, then it also supports that valuation. to say your worst case scenario, if all went wrong, $20 per share. If the squeeze never happened, which I'm not saying that's even a possibility, the data does not support that. But even if it didn't, $20 per share, worst case scenario. So I think there's a lot more compelling case here to be long on AMC stock rather than to be short on AMC stock. It's going to be, very clear what the business outlook is going to be after 2022. And like I said, I think they're going to make potentially record profits next year. So that's basically going to be all for this video. Just some things I want to go over with you guys: margin requirements, Spiderman numbers, as well as the institutional ownership that is increasing at a pretty much a record pace. So hope you guys had a Merry Christmas. Hit the like button for me. Consider subscribing to the channel. Let me know down below in the comment section, what do you guys think about this information. Merry Christmas. Happy holidays. Looking forward to the new year. I hope you guys are as well. It's going to be very exciting. That's going to be all for this video, though. I'll see you in the next one.